Welcome to Inside India. I'm Amitoj Singh, and these are your headlines. India market futures indicating more upside when markets open today, following broad-based gains across Asia and Wall Street overnight. India's central bank says growth remains resilient despite trade uncertainties, projecting the economy grew at its fastest pace in 1.5 years. And India securing a trade deal with New Zealand, covering a range of goods, labour and investment, though New Delhi retained protection for its domestic farmers, keeping dairy off the table.
A, India is never going to open up dairy, so that concern really doesn't matter. B, it's only a consultation, no commitment.
All right, let's get started with a look at the Asian markets. They're mostly in the green. Remember, Japan was down by about 0.1% earlier today, but it's up right now about 0.1%. So a lot happening there, but mostly muted Japan after gains, big gains on Monday. We're also seeing that Australia is now set to have a fourth straight day of gains, up about more than 1%. It's a big one for Australia. New Zealand up about 0.15%. It's also the AI trade that we're watching because that's lifting Asia after it. It really did lift Wall Street overnight. The S&P 500 gained about 0.64%, posting its third positive day in a row. And it is Santa season, Santa rally. Since 1928, the S&P 500 has risen 75% of the time in the last 2 weeks of December, rising about 1.3% on average. And this is according to Citadel Securities. Now, we can also talk about some of the companies that are fueling this AI trade positivity in Asia, and that's NVIDIA. It's up 1% after reports that the company was looking to start shipments of its H200 chips to China by mid-Feb. And take a look at what you're seeing right now in China. The Shanghai Composite also up about 0.23%. Hang Seng up 0.22%. Micron also continuing its climb, up about 4%. Oracle also jumping 3% after the TikTok sale in the US announcement. All right. Let's give you a sense of India and New Zealand. We talked about the Kiwi market, but these two countries have concluded talks on a free trade agreement aimed at doubling bilateral trade over the next 5 years. The deal will cut or eliminate tariffs on 95% of New Zealand exports to India, with more than half of them going duty-free from day one, while all Indian goods will get duty-free access to New Zealand. Now, Wellington has also pledged to invest $20 billion in India over 15 years. The New Zealand Prime Minister Christopher Luxon called the gains significant, while India's Narendra Modi said the pact reflects strong political will. The agreement, expected to be signed in early 2026 within the first 3 months, follows recent trade deals with the UK and Oman. It still faces some political hurdles in New Zealand's parliament because out there it's not clear whether the coalition government will support the deal. In fact, they're saying they won't. Now, the deal also includes sensitive farm products like dairy and sugar to protect India's local producers. And India's Commerce Minister Piyush Goyal says the country won't open those sectors in any FTA.
Well, it's just that if we ever give dairy concessions, and you're all aware we have not opened up dairy in a single FTA for anybody. They were concerned that if we open up dairy for some other comparable economy, where the per capita GDP is similar, the size of the economy is similar, the dairy production level is similar to New Zealand, then at least they should have an opportunity to discuss with us whether we can extend similar benefits to them. A, India is never going to open up dairy, so that concern really doesn't matter. B, it's only a consultation, no commitment.
India's Commerce Minister also weighing in on other trade negotiations at that same press conference.
It's also our third FTA with a Five Eyes nation, Australia, UK, and now New Zealand. We are soon going to launch discussions for the terms of reference with Canada also. And we are already at an advanced stage in our discussions with the USA. This reflects the growing strategic importance of India in world geopolitics.
All right, how have the Indian markets digested this? So we're going to know in about 40 minutes. Gift Nifty futures indicating the following: up about 0.09%, 26,256. We're going back to that 26,300 record figure from September 2024. We're also seeing Nifty climbing from a couple of days, weeks almost, of losses. It was at 26,172 on Monday at close, but it's indicating that it will go all the way up to 26,256. Which means that we'll have two sessions in a row that India would be gaining. Will the law of averages really kick in? The AI trade also having a positive impact in most of Asia. But remember, India is not as much part of the AI trade. That's one argument. So will it partake in this? Critically, after 3 sessions of buying, FPIs have sold some 50 million USD. We're also watching the rupee, and let's bring you in to talk about that, because it's about the RBI, whether it'll intervene. We're focusing on the rupee. We have been for a while. The Reserve Bank of India had sold nearly $12 billion in the foreign exchange market in October to support the currency. And according to official data, the RBI bought 17.7 billion and sold nearly 29.6 billion during the month. The rupee closed October near record lows and briefly hit a fresh low last week before recovering on central bank intervention, according to reports. The RBI said it continues to step in to curb excessive currency volatility, but the currency has emerged as Asia's weakest this year. But the rupee slide could also be helping the remittances coming into India. A weaker rupee means foreign currencies hold more value, and India is one of the highest remittance receivers in the world. In the last fiscal year, Indians working abroad sent a record $135 billion back home. India also topped the list of recipient countries for remittances last year, sending back more than double what Mexico did in 2024, which came in second. To talk about that and more, we have Jasbir Singh Juneja. He's a partner at Red Seer Strategy Consultants. Thanks so much for joining us, Jasbir. I appreciate this a lot. You've also been part of a report with WISE where you talk about how India's students lost 1,700 crores, which is about 170 million in hidden bank fees, nearly 3 times the cost of Chandrayaan 3. But there are 35 million people of Indian origin living abroad. I just want to get to understand the impact of the rupee that you see in 2026 on remittances to start with. Can you give us a sense of that?
Thanks for having me, Amitoj. Pleasure to be here. See, our sense is that, because of rupee losing value, right? I think the diaspora outside India, the Indian diaspora, right? They tend to think that they're sending more, right? With the same dollar value, they're going to send more to India. So we do expect an increase in remittances, right? That's historically also, right? Whenever there has been sharper declines in USD INR, right? You typically see a higher remittance to India, and just that mindset thing for people that they are gonna send, right, with the same budget that they can afford to send a lot more to India, right? I think that kind of kicks in. So that is what we expect, right? In going forward as well, right? If you see that, let's say there was about 14% increase vis-a-vis last year in remittances, right? We do think that it is gonna be that rate is gonna be even higher in 2026.
Right. Is there a shift though that you're noticing where the psychology is shifting, that the rupee is losing value, so let's just not send it right now. Let's keep it, abroad.
No, I think there are maybe 2 sets of folks out there, right? There are folks in India who want to park their money in dollars, right? But in terms of people who are sending money to India, right? And again, right? There is a large chunk who sends it to their parents or their family who are still here, right? And it is probably support money in the Indian context, right? That is what they're sending back to India, right? We do not expect that that is going to decline at all.
Okay. Can I just ask you then, what is the trend? The number of people who are wanting to park dollars abroad, or the number of people who want to send money back to India? Which is higher now?
From the Indian context, right? The laws and the channels are just opening up that see Indians can park their money in US dollar or US stock, right? The taxation in terms of right, where does it get taxed, right? Even that is getting clearer for the Indian mind folks, right? There are multiple apps which support for Indians to be able to buy US stock, right? And bonds and whatnot, right? So that, right, in percentage terms, it will always look much higher. The base is too small. The base has been very small over the years, right? And suddenly that percentage terms would look much higher, right? But in terms of absolute money, not so much, right? If that makes sense, Amitoj.
Yeah, no, it does. I mean, just for our viewers, let's just give some numbers. We talked about how the Indian diaspora sent about 135 billion in the last fiscal year, the highest on record. But outward remittances, they were at about 29 or 30 billion in FY25. And that's, far lesser than the 135, but they've been reducing. And of course, this doesn't account for those who are already abroad and not sending money back to India. But that gives you a bit of a sense of where that conversation is. I was talking to some analysts earlier, and one of the things that they suggested was that it isn't so much to do with the rupee as it is to do with the fact that there is indeed a dire need in India to send money back to their families, and that's the engine room. How much of that has evolved or changed from the past 5 years?
No, and that's what Amitoj, when I said that it is support money back to the family, right? That's what I meant, right? That need doesn't go away, right? That requirement to be able to support the family back home in India, right? That doesn't go away. And in some sense, that psychology starts kicking in that by same dollar value, you're sending more. And who knows, right, what it's going to be next month. So maybe put in an extra buck or two, right, back in India, right? I think that is far higher. Now, you mentioned a number of say India remittance abroad, right? Indians who send money outside, right? Very less, very minuscule part of it is in buying stocks or something, right? Majority that, and that was our report that you just referred to, Amitoj, right? Majority of that money is, let's say, a dependent, right? Typically a student going abroad to study, right? Because the student doesn't have any means of earning yet, right? And then that, the family is either taking a loan, right, or from their personal saving, they are funding the students' education, right? Now that money, right, is that 30 odd billion dollar that you discussed, right? That is the money there, right? And that dynamics is also changing, by the way, right? US has been, you know, is the biggest beneficiary, right, of Indian students going to US, right, and supporting, again, and it's a two-way thing, but
Yeah.
let's say supporting the US universities by paying the
Yeah.
fees, right? But that money, right? That dynamics has come suddenly into play on how say visa issuance and everything would kick in or affect the next year, right?
Okay.
But two separate
Yeah.
pools, I don't think should be mixed altogether.
Okay, so let me ask you this. Are you expecting any changes, any declines to that in the next year? And I say this for the following reasons. You say the need doesn't go away, but there are a couple of points. The first is that there are tighter visa rules across the world, which are not favoring Indian students, which are not favoring Indian professionals. H-1B visa pathways are getting tighter. In New Delhi, you're in the national capital region right now, you're seeing that there are long lines outside US embassies and in Mumbai. Layoffs across global tech firms, whether it's related to AI or the general economy, that's a separate question. But then at the same time, you have this counterfactor, which is the multinational companies that are coming to set up those GCCs in India to hire locally. So how will this impact the fact that potentially they might be more cautious. Those Indians, those NRIs who send money back home. Will you see this decline happen?
Okay. Now, let me answer that in one form or the other, right? See, we tend to, again, from the consulting side, when we are analyzing the data, right, we tend to think in terms of stocks and flows, right? That there is a whole lot of Indian diaspora who's already out there in US, right? And every year, some change, right? Some flow happens, right? Now, I think that is the entire crux of it, to be able to realize that the new folks we are adding, right, is a smaller in number, right? And as soon as they reach US, their capacity to send money back to India is even smaller, right? So the change doesn't necessarily kick in year 1 or 2, right? If this visa issues and everything persists, and the mentality that US may not be a favorable place for students to go, or for even for the IT sector, the employees to COVID, right? I think in a few years it may kick in, right? But
Okay.
for the immediate future, an year or two, right, things go as is, right? There is probably a small change or decline, right? But nothing that could be
Okay.
pinpointed to this kind of a smaller factor.
We got to also account for the fact that the Indian NRI who's sending money back to India, or vice versa, actually, the Indian who's sending money abroad, they're getting smarter about finances. They understand your report. What it says is significant, right? 1,700 crore, translated to about USD 200 million, was lost in 2024. And that was only because of exchange rate markups and banking fees. In that context, with the rupee also, weakening, is it possible that they'll be like, hey, what's the point of sending money when we're going to lose so much, and just sending it across for fees and the rupee? I'm not sure if that's something you can give some thought on.
No, sure. And again, it's a mentality thing, right? Amitoj, right? I think there has been a markup fee forever. It is newer fintechs which have been against or challenging the traditional banking segment by removing these fees, managing their own fees better, and passing on the benefits to the end consumer, right? So what we'll see, and by the way, right, there were always these multiple channels available. People who are gonna send money back to India, right? They'll always figure out where is the maximum benefit they are getting, right? That will always there. Now it just becomes easier with technology, right? And with players like the remittance players like Wise, right? It just becomes easier to send money
Okay.
or get money without that markup fee. But we do not, right? The shorter answer is, right, we do not foresee that it does make, from the perception perspective, right, it makes marked difference
Yeah.
about this 2% fees that we are discussing here.
Okay. There are two other trends. One is that there's a surge in outbound travel. More Indians are traveling and spending time abroad. And the other is that wealthy Indians are actually just migrating outside. They're going abroad to settle, whether it be because of pollution or whatever reason. That is denting net remittance inflows. What's the future of that kind of an impact?
No, sure. So again, Amitoj, we broadly discussed that, let's say, remittances last year increased by 14 odd percent, right? But historically, if you go back, right, maybe the last 10 years, right, the overall increase has been far muted, right? It is probably in the range of maybe 8-ish%, right? CAGR terms. That is what it has been, right? Now, is it sustainable at 14%, right? We think that, maybe next year it would still probably go up by maybe another percentage point, but then it would start reducing, right? And going back to a more reasonable number, right? So the shorter answer, Amitoj, to your question is, right, the trend is absolutely there, but we don't see it playing out in 2026 by any marked difference, right? It is probably going to be another 2, 3 years that we'll start seeing noticeable numbers in there.
Okay. Jasbir Singh ji, thank you so much. That was Jasbir Singh Juneja, Red Seer Strategy Consultants, giving us a sense of the story around remittances and India. We'll be taking a short break. On the other side, we take a look at what's plaguing China's property sector. Don't go anywhere. Welcome back. China has been in a property slump for a long time now. Our China reporter, Elaine Yu, joins us with a deeper look at the sectors. Elaine, it's good to see you. Where does the sector figure on Beijing's priority list?
Amitosh, good question. The priority wasn't high, but now there seems like there's a bit more urgency with home prices still falling after years. The crisis started with Evergrande's default and later collapse, but the pain has spread to developers that were previously seen as immune, like Country Garden, and even today, the state-backed China Vanke that narrowly dodged default, but the clock is ticking for them. So there's no sign of easing for the wider property sector, and this crisis is a major drag on consumer spending. And if you recall, Beijing imposed the 3 red lines 5 years ago to rein in developers' excessive debt, and that was meant to create a healthier consumer economy, not one that's based on speculating on home prices. But the irony is that that debt crackdown has now hurt consumer appetite. And as 2025 draws to a close, we took a step back to see why this crisis has dragged on for so long. And we also look ahead to see what to expect in the coming year. Let's take a look.
Nearly a decade ago, President Xi Jinping declared that houses are for living, not speculation, setting the stage to deflate China's debt-fueled property bubble. A crackdown on developers' heavy borrowing followed, triggering a liquidity crisis and leaving millions of homes unfinished. Plunging home values wiped out household wealth. This crushed consumer confidence and their willingness to spend. For most of 2025, Beijing stayed hands-off as prices kept falling, suggesting a correction was necessary. Now the tone has shifted. Chinese leaders named stabilizing the sector a key task for next year. But don't expect a quick fix. Analysts see prices bottoming in early 2027 at best.
Probably we are going to see more intervention in the let's say in 3 to 4 months' time. Yeah, because there's the growing need to backstop the prices.
The numbers are stark. In November, secondhand home prices across 100 cities fell steepest this year. Tier 1 cities are falling faster than smaller markets. Beijing's agenda-setting meeting in December focused on clearing inventory and encouraging state purchases of unsold homes for affordable housing. Economists also expect interest subsidies for mortgages and looser buying rules in some cities.
I think going to next year, all these options are open, but the question is how much resources the government will have to provide, and where the money come from.
Inventory plays a role. Guangzhou lifted buying curbs last year, but prices have stayed weak due to oversupply, according to the Economist Intelligence Unit. Hangzhou, home to startups like DeepSeek and Unitree, also relaxed rules and fared better, thanks to reduced inventory and an influx of tech talent. Shanghai's ability to attract people helped soften the blow, while Beijing's strict population and home buyer restrictions are keeping a lid on activity. Secondhand prices in the capital are tumbling and could drop further as buyers favor newly built homes, says a Beijing-based agent.
The further prices fall, the more buyers fear purchasing at a high price point. This wait-and-see sentiment is becoming severe.
The negative equity trap is hitting hard. One Beijing homeowner bought for 2.6 million yuan and is now listing at 2.25 million, the agent says, meaning they'll need extra cash to repay the loan if the property sells. But any stimulus measures may be conditional on further price drops. Meanwhile, the IMF has urged China to let unviable developers go, calling them zombie firms.
That's a tough choice, right? I mean, these really is kind of a trade-off between short-term and long-term pain.
Intervention is on its way, but for now, caution looms large.
So Beijing has viewed the correction as perhaps painful but needed medicine. But home buyers and investors and economists will be watching for signals on how Chinese policymakers will address this crisis in the 2 sessions in March. Amitosh.
Thanks so much for that, Elaine. Coming up, we will take a deep dive into India's booming quick commerce space where profitability concerns are still swirling. Stay with us. Welcome back. You're watching Inside India. Some of the stories that we're keeping tabs on outside of India. Let's give you a sense of that. Thailand and Cambodia have agreed to discuss a truce on December 24th after ASEAN diplomats urged both countries to exercise restraint during a special session in Malaysia yesterday. This decision marks a significant step towards ending hostilities, which flared up 3 weeks ago, despite a ceasefire earlier this year. Here's what the Thai foreign minister had to say on the meeting.
The meeting is scheduled, and this is proposed by the Cambodian side, on the 24th of December. So we will be working towards, and this time, let's thrash out the details, make sure that the ceasefire reflects the situation on the ground, and the ceasefire is one that really holds, and both sides are going to fully respect the ceasefire.
President Trump has named Louisiana Governor Jeff Landry as a special envoy to Greenland. Landry's appointment quickly drew criticism from both Denmark and Greenland, as Landry has shown public support for President Trump's desire to make Greenland a part of the United States. Greenland is a self-governing Danish territory, but Trump says owning it would be a matter of national security. Also, President Trump ramping up pressure on Venezuelan President Nicolas Maduro, saying it would be, quote, smart for him to leave power. The U.S. has expanded its military presence in the South American region and seized one oil tanker last week. It has since intercepted another tanker and is actively pursuing a third. Trump talked about what he would do with that seized oil.
The oil that has been seized. The United States seized 1.9 million barrels of oil on December 10th.
We're going to keep it.
Where's it going? Are we going to sell it or put it in the strategic?
Maybe we'll sell it. Maybe we'll keep it. Maybe we'll use it in the strategic reserves. We're keeping it. We're keeping the ships also.
We're also counting down to the market open in India at this point in time. This is how we're shaping up. Well, it's going to be muted is what we understand. We're looking at Nifty 50 not really climbing much from that 26,172 that we did see yesterday. And we're looking at, the possibility of it going all the way to a record high that we saw in September 2024. We're also noticing that potentially we can see that the rupee is going to weaken against the US dollar after a couple of days of strengthening based on reports around how the RBI has, in fact, been intervening. The AI trade that has been fueling the market in Asia and, of course, following what's happened in Wall Street, will it have an impact in India is another key question. We're also watching FPIs and whether they will once again pull out money as they did yesterday after 2 days of actually net buying. Now, the Indian economy maintained strong growth momentum in November, supported by robust private and urban consumption. The Reserve Bank of India said in its monthly bulletin. The central bank noted that high-frequency indicators showed economic activity holding up after the festive season. India grew 8.2% in the July-September quarter, its fastest pace in 6 quarters despite global trade uncertainties. The RBI said coordinated fiscal and monetary policies, including 125 basis points of rate cuts this year, have supported growth. It raised its full-year GDP forecast to 7.3%, while keeping inflation projections subdued. Now, India's 8 core industries also grew 1.8% in November, snapping a contraction in October, according to official data. It was supported by strong production in cement, steel, and fertilizers. However, overall growth remained subdued as crude oil, natural gas, and refinery products continue to contract. Core sector growth was sharply lower than the 5.8% expansion a year earlier, reflecting a strong base effect. We're also watching another key sector, India's network of dark stores, micro warehouses enabling ultra-fast online deliveries. That is set to nearly triple to about 7,500 by 2030, driven by booming quick commerce demand. And that's according to Savills India. As of now, around 2,500 dark stores operate across metros and more than 100 smaller cities, with players like Blinkit, Swiggy, Instamart, Zepto, and Reliance Retail racing to expand. The growth reflects rising consumer demand for rapid delivery of groceries and essentials as quick commerce firms push into Tier 2 and Tier 3 markets. Elara Capital said says categories are expanding fast, but the sector will still focus mainly on high-frequency, on-demand items until logistics scale up. And that's why we've got Karan Taurani from Elara Capital. He is the EVP. Karan, it's a pleasure to have you on. Thanks so much for joining us from Mumbai. I think I just want to start with asking you one main question. Is e-commerce in India or quick commerce in India a bubble?
Hi, good morning. So we don't foresee e-commerce or quick commerce being a bubble. I think quick commerce will only amplify growth rate of e-commerce market in India. There have been many categories, beauty, personal care, general merchandise, grocery, which have not seen rapid adoption on e-commerce. Consumers would rather purchase this from the offline store and wouldn't want to call them online. But because of QCOM, because of convenience, and because of these products now being available within 10 minutes, consumers are wanting to call this on a convenience basis. And this will lead to more increased penetration of these categories online, which will drive the overall e-commerce growth rate in a very strong manner. So if you look at the QCOM market, it's only about 10% of India e-com today. Potentially, it can grow by 50% CAGR over the next 2 to 3 years if it scales up in the non-metro markets. And we do see QCOM as a contribution of e-com market, potentially even going to 40-50% over the medium to long-term perspective, because there are many verticals and categories which will see rapid adoption towards online because of QCOM.
Okay. Interesting that you say that, because Blinkit's CEO, Albinder Dhinsa, he reportedly told Bloomberg that India's quick commerce industry is heading for a shakeout, in other words, a bubble burst, as the model of burning cash for 10-minute deliveries is unsustainable long-term. But you say it's not a bubble.
Yeah, so from a profitability standpoint, definitely, if companies don't move to a path to profitability, there could be a bubble. It's been almost about 3 to 5 years that QCOM is existing in a market like India. We have seen 3 to 4 players entering this space very aggressively. We have seen fragmentation as well. We've seen smaller players like Zepto come in, becoming into larger players. We've seen the mighty entry of e-commerce players like Flipkart, Amazon getting into this segment. So because of this high TAM that QCOM has got, because of the big opportunity that QCOM has got in terms of penetrating into multiple verticals, most of these companies are also indulging in a price war, which is leading to heavy discounts and also hefty losses for most of these companies. So I think it's about time that most of these companies try to arrest this and move towards a path to profitability and at least show a break-even point and even go for higher profitability over the medium to long-term perspective. Because if that does not happen, then definitely these companies will find it tough to raise capital time and again, and that could be a bubble scenario. But as we speak right now, I think with Zepto planning to go IPO and with Swiggy in the recent fundraise, that they want to focus on 1P model, they want to focus on QCOM expansion. We believe that price wars are largely behind us. Whatever investment in terms of A&P spends that will be done in QCOM going ahead will largely be done to create the category in the non-metro markets. So we don't see price wars escalating from current levels. We do believe that in the next 6 to 12 months, you will see a path to profitability as far as QCOM is concerned.
I want to ask you, how do you see this path to profitability? Simply because the fundraising has been relentless. And just to put some numbers out there, India's quick commerce sector has been seen massive fundraising, with Traction reporting over 1.77 billion in 2024 and around 449 million by the end of 2025, which could obviously be a different number. We've seen Swiggy preparing a 1.1 billion share sale. You yourself mentioned competitor Zepto raising 450 million ahead of a planned initial public offering. So how long can relentless fundraising last if you are suggesting that profitability focus will come in very soon?
So I think what we saw in the month of Feb at the start of CY25, we saw heavy cash burn from companies like Zepto, which actually entered the market and came in the form of a very bad price war for the market, so to say. I think that situation is kind of behind us. If you look at most of the e-commerce companies, Flipkart and Amazon, who are wanting to make an entry into QCOM, they are not indulging into any kind of price war. They are basically trying to play on consumer experience. They are basically trying to pay in terms of assortments and also in terms of their tech stack and to protect their market share, because e-com is invariably losing market share to QCOM. So I think QCOM is not only about pricing and discounting. QCOM is also about experience and what assortments the consumer getting the right product at the right time. So putting all these factors into place, given the kind of burn these companies have done, we don't see situation worsening from here on. But yes, there are a lot of levers of margin improvement. I think if you look at most of these companies, they are moving towards a 1P model, which could lead to better margins for these companies. And there is a big lever in terms of advertising revenue for most of these e-commerce platforms. And there's also lever in terms of increasing take rates from brands. So because of these levers, we do believe that there's a potential for going to a path to profitability over the next 6 to 12 months, assuming that the price wars are largely behind us.
I'm interested in what you said, that the likes of Amazon and others, Flipkart, Reliance, are not indulging in these price wars. But the price war isn't really about them because they don't have that market share just yet. They could bring in money and put in a lot of money. They have the capital, and then the game could completely change. Right now, it's mostly about Swiggy and Blinkit. But let's talk about your study, because India's network of dark stores that you have said will triple to about 7,500. From the 2,500 dark stores. I beg your pardon, not your study, but a study. Just give us a sense of what you think is going to sustain that kind of growth, what you feel is going to happen in tier 2, tier 3, tier 4 cities. I can give you an example coming from a very small town where there's a new company. It's called Fatafat, which translates in English to, very quickly, rapidly. And that is giving competition to Zomato in this little town that I'm from. So just want to get your sense on that.
So I think QCOM definitely will scale up in the non-metro markets, but the time frame is going to be different here. So within 3 to 4 years, QCOM actually saw massive success in terms of growth, profitability, and penetration in the metro markets. The way non-metro markets will behave will be slightly different, primarily because consumers may not want the product within 10 minutes, right? So they have to actually identify some kind of modes to play with. So QCOM companies will actually try to bet on assortments which are not available in the metro markets. They will try to place that in non-metro markets because that could be an aspiration for the consumer in terms of buying habits there. They could play on other assortments which are available in malls, which are maybe far away from the households. And these are two factors which will actually drive QCOM penetration in non-metro markets. So QCOM penetration in non-metro markets is definitely here to stay. But the time frame could be anywhere between 5 to 7 years, unless we see a rampant expansion the way we saw in the metro markets. As far as store numbers are concerned, I think most companies are now in a dilemma whether to grow or whether to chase a path to profitability because the opportunity is very huge here. So if you look at India's e-com market, as per estimates, it's a $100 billion market. And as mentioned earlier, QCOM is only 10% of this overall market. And given the kind of categories QCOM can penetrate into, so if you look at the categories of the grocery, if you look at categories like apparel, beauty, personal care, QCOM can actually go to 70-80% of the e-com in terms of these particular categories. It's only white goods and the high-value items where QCOM cannot penetrate beyond a certain point. So putting that into perspective, 60% of e-com market is available as a TAM. And that gives the entire opportunity for more than 3 to 4 players to coexist here. Unlike the food tech business, which is dominated by 2 or 3 players, but the market is 1/5 or 1/6 as compared to the QCOM market.
Mm-hmm. Okay, your study says the categories are expanding fast, but the sector will still focus mainly on high-frequency, on-demand items until logistics scale up. Since you referred to the idea of where India stands in the global, quick commerce conversation, I want to ask you about that. Quick commerce has failed in almost every country, and India is an outlier. But why do you think in the future it will succeed in India? What is the key element that will make it succeed?
So I think QCOM in India has done well primarily because of 2 major reasons. One is the Gen Z. If you look at the Gen Z consumers, they are wanting things on a convenience basis, on 10 minutes basis. Second thing is the logistics. So I think QCOM logistics have actually been far cheaper as compared to the emerging markets. And because of the Gen Z consumer habit, because of them being impulsed to buy out certain kind of categories, the frequencies have been higher. So because of these 2 factors, QCOM as a business model has actually clicked well in the metro market so far, both in terms of penetration and in terms of profitability.
It's been cheaper, and that's because these companies are expanding and trying to make profit on the backs of delivery executives or gig workers who are not making enough money. And you've seen, I'm sure, reels of some workers suggesting that they've been working 15 hours and only making some 700 Indian rupees. I want to understand, how is that sustainable? How is it that you have 65% of the population of India above the age of 35? And these are people who are educated sometimes. They are being pushed into this space because there are not enough jobs. and you have these quick commerce and e-commerce companies taking advantage of this kind of labor. And that's why this is succeeding in India.
So I think labor cost in India is low, and that's the reason why QCom has actually picked up or scaled. That's one reason. Now, within that, if you clearly see, most of these gig workers on working like platforms like Zomato, Swiggy, or Blinkit, Instamart, the advantage that they have is higher throughput, right? So in terms of per day basis, they do almost 12 orders per day in the food tech side. On the QCom side, they're doing almost about 20 plus orders per day. And they are roughly paid in the range of 40 to 60 rupees on a per order basis. So they are making a reasonable amount of income. And going ahead, we do have an ample supply in terms of the number of gig workers which could be available for a market like India.
Is that reasonable?
I think as of now, it seems to be a reasonable amount. 25,000 rupees is what they make. And including variables, that number could actually go higher. And these may not be educated people. These may be just the start guys in terms of the age group of 25 to 30 who would want to start their career in life with. And there's ample supply of these kind of people available for the next 5 years.
Yeah, but this is not an aspirational job. This is a job that they have to do because they're not getting jobs. And if they have the opportunity to move to another job, they will certainly take it. And given the competition, the price was, it's likely that this kind of, labor supply is not going to be sustainable for, and even keeping in mind that labor reforms have just come in. And that is going to add a cost to these companies, these quick commerce and e-commerce companies, where now gig workers have been formalized in a sense. The companies have to provide insurance to them. There are rules around shifts. There's more pressure. And the salaries and the bonuses and the hikes are not going to come. So will this labor supply change anything?
So firstly, in terms of labor supply, as per many of the government authority Niti Aayog reports, there are about 10 million gig workers in the economy today. In the next 5 to 7 years, there'll actually be a supply of more than 20 million gig workers. So in terms of demand-supply mismatch, at least for the next 5 to 7 years, we don't see any issues there. Second, in terms of the labor code which has just come in, so most of these companies already provide a lot of healthcare benefits, a lot of insurance benefits, and in maternity benefits to the gig workers. Additionally, they may have to contribute some amounts in terms of the PPF or maybe some incremental life insurance benefits, which could actually have a negative impact of 3 to 4 rupees on a per order basis. So basis that, I think this will be recovered from the consumer eventually. So even that per se is not a huge negative impact as of now.
Okay, final question for you, and this is really the key question. And you can, it's in two parts. The first is simple. Who's winning this quick commerce battle competition in your view? And so it's a one-word answer. You just have to name the company. The second question is perhaps more complicated, where I want to ask you, beyond existing shareholders, what is the return for retailers, retail shareholders, value creation for them, if profitability in this battle is going to come in 15 years, according to most studies, 20 years perhaps?
So firstly, I think Blinkit is a clear winner because of execution. That's the one-word answer in terms of who's the best player in QCom today. I think they'll kind of maintain that leadership position because of their tech stack, user experience, and assortments, everything put together. Second question in terms of where will QCom head and where do the investors go in terms of valuations? See, I think e-com market in India actually took off about 15 to 17 years back. And if you look at the likes of Myntra, they've achieved a break-even last year. Flipkart, Amazon could achieve a break-even in the next 2 to 3 years. If QCom did not happen, they could have been achieved a break-even next year, right? So I think e-commerce business as such is such wherein 15 to 20 years are high growth phases. We have seen that with every company globally. If you look at the likes of Alibaba and Amazon, for the first 15, 20 years, most of these companies get into high growth phases. And that's when they actually burn a huge amount of money to create the customer base, to create the entire technology. And once that is done, for the next 10, 15 years, these companies throw a hefty amount of cash flows and profitability. So I think Blinkit is somewhere in the middle right now. They will actually in the next 5 years will have a very steady path in terms of profitability if the price wars were to de-escalate from here on, right? The other aspect to look at is that these companies are not to be played from a near-term perspective. These companies are to be played from a medium-term perspective. And I think you have to actually bet on companies which have been top-notch in terms of execution or probably been market leaders, which is the likes of Blinkit again. And third thing to look at here is that most of the companies like Eternal today, specifically to the global companies, when you benchmark them in terms of growth, they have been at a massive premium in every life cycle. So we've actually tried to compare internet companies globally in life cycle of 30 years, within a 5-year cycle, each of these cycles which are there. So each of these life cycle of 5 years, most of these companies have been at a hefty premium growth rate as compared to the global counterparts. And in terms of profitability, they are right there. So I think if you look at something like an Amazon, they started to throw profitability after 17 to 18 years of operation. If you look at the food tech business, it's about 15 years old plus roughly, and they are now in terms of healthy profitability operation today. So going ahead, QCOM also the next 5 to 7 years will evolve in terms of profitability.
One sentence answer. Do you not have any fears for retail investors?
I think if they're playing for the medium long-term perspective, they should not fear this because it's a huge opportunity. And once profitability does come in, you see massive operating leverage for these kind of businesses.
Karan Taurani from Elara Capital. Thanks so much for taking all those questions and coming on. Appreciate that a lot. All right, Indian markets have indeed joined the trading day. We will look at some movers in Mumbai after a short break. We're back in just 2 minutes. Welcome back. Indian markets are online as expected. Nifty 50 with a bit of a muted start. We did expect that. We've been watching a couple of different sentiment movers. We're looking at the Wall Street AI trade that has really had an impact on Asia, where it's been mostly green. We've seen that impacting over the last 2 days. But has it had an impact on India? Yes. In the last day, yes, it did. Today, we'll have to wait and see. There are a couple of other things that changed yesterday, and that might also continue. That trend might continue. We're talking about FPI money. FPI money was coming in for 2 days last week. Yesterday went back out, and that's why we're watching this space very closely. How does Nifty 50 really react to that? The New Zealand and India trade deal, some positivity when you're watching complete silence almost regarding the US and India trade deal for months now. But then again, you're also seeing the RBI intervening, according to reports, to try to strengthen the Indian rupee. At this point in time, weakening just a bit at 89.67, but much better than the 91 low that it has seen, that has also made it one of the worst performing currencies of the year. Let's also take a look at some of the movers in the Indian markets today. We're watching Adani Group firm Ambuja Cements has approved the merger of its subsidiaries ACC and Orient Cement to create a single consolidated one cement platform. The company says the move will boost operational efficiency, streamline manufacturing and logistics, and cut costs, helping raise margins by at least 100 rupees per ton. Under the plan, ACC and Orient Cement shareholders will receive Ambuja shares based on a fixed swap ratio. The merger is expected to be completed within a year, subject to approvals. The stocks at this point of all three, well, Ambuja and Orient up about, well, 2.6 and 6.40 respectively. ACC down just about 1%. Meanwhile, another technical glitch at Air India. India's aviation regulator says an Air India Boeing 777 returned to Delhi shortly after takeoff after oil pressure dropped to zero in one of its engines. The crew shut down the affected engine and the aircraft landed safely with no injuries reported. The aircraft was bound for Mumbai. In the meantime, the airline is also set to induct the first of its 20 Boeing 787-9 early next year. This is part of Air India's plans to boost its long-haul capacity. So we're watching many different parts of the Indian market very closely. But for the moment, that's all the time we have today on Inside India. Of course, it goes without saying, keep watching CNBC. Access Middle East is up next.